There are hundreds of thousands of tools that people use in trading. Some use SMC, some use ICT, some all kinds of name. But what I've just discovered is that it's just a reinvention of the traditional trading strategy, only that people wanted to sell and try to give it a new name and use another approach, even though it's the same thing. People try to use another approach and then it look unique. What matters most in trading is the trading psychology, the most important thing. Every analysis, every technical analysis style, once it has been well learned, works. All the indicators works. If you know how to use it, it works. But then the problem is the trading psychology. There are three types of capital in trading that you need. Not just the financial capital. Many people, the reason they have not learned Forex, even though they are interested, is because they say, I don't have the financial capital to start. The financial capital is not the first thing you need. The first thing you need is mental capital and emotional capital. Then, before the financial capital, the mental capital is the skill. The emotional capital is the psychology. Then, before the physical capital. Once you have the first two, I can guarantee you, if you borrow money in the bank, within 3-6 months, you pay back the money in full. I can guarantee you, if you go to the bank and get a money or go to any money shop to get money, within 3-6 months, that money will be refunded if you have a robust mental and emotional capital. So the financial capital is not the main thing here. So I mentioned that there are 5 tools that I use in trading. It has been proven by my mentors. It has been proven by me, proven by my mentor who have been trading for over 40 years. And all his life, he has been able to earn fortune all his life from Forex trading. He poured all the returns from Forex trading into real estate. And I'm following the same pattern too. Whatever money we are getting from Forex, we are not returning it back to Forex. We are taking it into real estate investment and some other investment. For 40 years, these are the traditional tools he's been using. I've also been using it since I met him. My trading life changed, and I can guarantee you that these tools are working well. With patience and discipline, consistent discipline, you will be getting results day in, day out, week in, week out, month in, month out. You will suddenly transfigure into a trader who is not losing this week, making money next week. Rather, you are consistently making money, even though the return might be little, based on the strategy I am teaching you and I'm emphasizing, particularly when it comes to risk management. When it comes to risk management, I am very tough on that. So it is the trend. We trade alongside with the trend. We try to avoid sideways market movements. We try to avoid any choppy market. We try to look for a trade that is trending. Even if the trend is a short-term trend, we can quickly spot an opportunity and then trade a trending market condition. Then the tools we use, the trend line, which I was trying to explain yesterday, and then we have started practicing. Then the moving averages, the Fibonacci retracement, the chart pattern, and then the candlestick pattern. These are the things we put together. And please take note, none of these tools should be used in isolation. For example, the trend line is just to identify market direction. Market direction, spotting the level of rejection when the market is in the bullish trend. We use it to spot support, to find our support. Areas of rejection is called support when the market is going up. Then it is called resistance when the market is going down. There are areas of rejections. That's what we use the trend line to identify. We use it also for our entry and exits. That's why you will see some trend line, you will have to draw the trend line that look like a channel. The upper channel, if you are in a bullish market condition, the upper channel could be your stop, your take profit. The lower channel behind it is where your stop loss will be. All of that we will explain as we begin to deepen our knowledge in this. So we use the trend line for trend strength analysis. Sometimes you discover that by the time you draw your trend line, the market is not coming to your trend line. Rather, is going higher and higher. That's to tell you that that market has a very strong momentum. And that should tell you straight away that this market has the opportunity to go higher because the momentum is strong. It's not coming back to test the trend line. Rather, it's forming a new swing above the trend line. So take note, when the price is above your trend line in a bullish market situation, it is having more momentum to go up. The moment it breaks the trend line, you need to start relaxing your bias. The moment it start breaking the trend line, start relaxing your bias, because that is to tell you that the momentum is no longer strong enough, is no longer stronger. That's what it means. Look at what we have here on the screen. Look at the first trend line that I have here. I did this yesterday. Immediately we finished our session, I was trying to see what could happen in gold. And I was able to place some buy trade on gold, and look at what gold is doing right now. Look at the first trend line. I was able to pick this low and this low. And look at, price didn't come back to this area. Rather, it started swinging higher from here. So I pick this area again from here, connecting this one. Let me see what we have in the message. Oh, okay, NFP. Yeah. Okay, so now I drew this one, and then you see that it's not coming here again. Rather, it's beginning to use the moving average. We'll be talking about the moving average today. It started riding on the moving averages. Then I know that the momentum for gold to go higher is very strong. And then I was able to pick out that channel. I find my support, and then I entered a buy. All of this, I will show you how we wait patiently to spot our entry to pick the trade. So today, the next thing we'll be talking about is the moving averages. These are very simple. The trend line, very simple to explain, very simple to identify. The moving average is very simple. I'm trying to let us go in a very steady way from the simple to the complex. From the simple to the complex. So we'll be talking about the moving averages. Now, the moving average, there are 4 moving averages that I use, but mostly I consider 3 as more effective. I use the 20. There are two types of moving averages. We have the simple moving average, and then we have the exponential moving average. I don't know about the exponential moving average. I've never used it. Some do. I don't know how it works. I don't know how because I've never learned it. So I just use what I know, what I have learned, and what has worked. Let me also quickly tell you this. The moment you discover what is working for you in Forex trading, don't learn anything new. Just repeat. Because I saw in the group where someone put that Forex, you keep learning, you keep learning, you keep learning. That might be correct, but not absolutely. I can argue that because you can actually learn something that is already working, and in the process of learning something new, you corrupt what you have learned that is already working, and then you start struggling. So once you learn something that is already working, it is already giving you results. Don't learn any new thing again. Just keep repeating and deepening your approach, strengthening your skill in that which you have learned that is giving you the result. I have come to a level right now that I will just open my system. I know when to trade. I come into the system 1 hour after the London session, 1 or 2 hours after the London session. I open the chart. I don't need to put the trend line anymore. I don't need to draw the trend line all the time. I just look at the market structure and I say, okay, I just need to wait for Euro USD for to see some movement, and then I'm going to trade. So you start deepening, you start strengthening your skill, what you have learned that is already working. So just me looking at the market structure alone, based on the chart pattern understanding, candlestick understanding, how the moving average works, the trend. Once I open the system, I just look and read what has happened previously. I'm looking at what is currently happening. I'm looking at the overview of everything. I can say this Euro USD is going to sell today. Euro USD is going to buy today. I might not enter immediately. I'll be waiting for my confirmations. So I am not learning anything new again. Why? Because this is already working for me. So what I'm just doing is a repeat of what I have learned. Averagely on a daily basis, averagely, I end the day with profit. It's very difficult for me to end the day without, no matter how small it is. On one of my accounts, it must be ended on profit, no matter how small it is. Averagely, even in between, I will have losing trades, but the day must end in a profitable trade. Why? Because what I've just discovered that is working, I'm just deepening it, deepening my strength in it, deepening my understanding in it. So once you have learned something in Forex that is working and you are here, I don't think you should learn anything new again. Just continue to deepen what you have learned that is working. But if you are here, you are still struggling with trading, learn something new. Yes. Once you start working, don't learn any other thing. Just continue to practice. Just continue to. It will now become boring. It will now become boring. Your trading becomes boring to you because all you are just doing is repeat every day. But making money can't be boring. The approach might be boring. All right, so we talk about the moving averages. I use the simple moving averages, and I use 50, 100, and 200. Then once in a while, I had 20 because of sometimes if I have to go to 15 minutes, the 20 moving average can be effective in the lower time frame. The 200 is the biggest, followed by the 100, followed by the 50, followed by the 20. The blue line is the 20. Let me take it out so that you can see it. The blue line is the 20. If you want to put your moving average on it, just go to your indicator where the indicator is and then type simple moving average. If you are using your laptop for analysis, I advise that you use TradingView. So you go there, you look for simple moving average. It gives you different number. Then you can always come there to adjust it. For example, let me show you. Let's say you go to the indicator and then you put simple moving average. Simple moving average. Sometimes you see the one that has been arranged there. So you just click on it and then redesign it the way you want. But if you pick the one without number, let's say you pick this one, you will need to come and edit it. You go to setting, and then you reconfigure it to your style. Length 20. So I'm making it 20 moving average. And then I'm trying to change the color. Okay, I want it blue. The visibility, okay, is fine for me this way. Then what else? Okay, it's fine. 20. Can you see that it has aligned with the previous 20 that I have there before? It has aligned with the previous 20. So let's say I want to change it to 50. Setting, I change it to 50. You see it? So that's how to put your moving average. But it's easier when you combine the one that has already been designed there. So the 50 to the 50, 100, and 200, you go to setting and reconfigure it as you want it. This is the style. Look at the color. You can change the color to whatever you want. It's not compulsory. It is like mine. I like my 50 to be yellow. I like my 100 to be black. I like my 200 to be red. And I try to change the weight here. You can decide to make it thicker, bigger as you want it. So that's the moving average. So now, how do we make use of the moving average? Now, listen to this one carefully. The moving average is not effective in a sideways market condition. When the market is not in a trend situation, the moving average will fail. It doesn't work. It's not effective. But when the market is trending, then you see the beauty of the moving average. Now, this is how the moving average, I use it. Some use moving average. They say when it crosses, I don't use when it crosses. In a bullish market situation, I use my moving average as my support. Support 1, support 2, support 3, support 4. I use it as my support. That means, you remember, when the price is moving, it moves this way. It moves this way. In a bullish market condition, this is how it moves. All right. Now, when it goes up and we have a high, and it's coming down for the high low, it will always come to bounce on one of the moving averages before taking off again. So when it comes on the moving average, is using the moving average as a support, an area of rejection. The price gets there, the price is rejecting, and then it bounces up again. So that is number one. I use my moving average as my support in a bullish market condition, and I use it as resistance in a bearish market condition. That's number one. Number two, as long as the price is above all the moving averages, it is another confirmation with the trend line that this momentum is strong, very strong, providing an opportunity to go higher in a bullish market condition. If it is in a bearish market condition, the price is trading below the trend line, the price is also below all the trend line. Trading below all the trend line, it means the momentum for the downside is very strong, and it will be an opportunity for me to look for my sell. It's as simple as that. It's as simple as that. So that is how we use the moving average. So sometime, for example, as gold is right now, gold is showing a sign that is going up. But do you know that if I'm going to trade gold right now, I can't enter a buy now because of the rule of how the moving average should be used? Your entry must be near the moving average. Near the moving average. If the price is already far away from the trend line, no problem. You can still find an entry. But if you must find an entry, it must be near the moving average. As it's bouncing on any of the moving averages, and then it's giving us a bullish candlestick confirmation near the moving average, you make your entry. So I can't enter this trade right now because the price at 2,694 is far away from the 20, the 50, the 100, the 200 moving average. It's far away. So I will be looking for a higher low situation where there is a pullback, and then the 20 moving average is the price is near the 20 moving average, and then it has given me 38%, 50%, or 62% Fibonacci retracement. So my entry must bring three of my trading tools into a confluence. So my entry will be that the market has pulled back, giving me a 38% or a 50% or a 62% of my Fibonacci retracement. Then I have one of the moving average in that zone, and then I have a candlestick confirmation around that zone. Boom, I'm in. So let's say, for example, gold has gotten to, let me make this illustration very clear now. Let's say gold actually got to, today gold got to this height, 2,697. Let's say that is the highest it's going to get today. It's not going to go below that. It will start coming down from there. I'm in a 1 hour chart pattern now. So now, the next thing I want to do if I want to trade a buy here is that I come to my Fibonacci retracement. I'm going to teach us how to use Fibonacci retracement tomorrow. So I come to the previous low I take it to the previous high, and then I go to, I look for my rectangle. This is my 38 up down to 62. That is going to be my buy zone. So I'm buying at that zone. That is going to be my buy zone. But then what I will be waiting for this price to come here. I'm waiting for the price to come here, somewhere here, and then I'm looking for something like this. Now, when the price drops to that zone, I'll be waiting for either the 50 or the 100. And if you still find the 20 there, the 20 moves faster. When I'm in 1 hour, I don't really bank on the 20. The 1 hour, the 20 always work in 15-minute time frame. So I will wait till one of these moving averages to also be at this zone. So I will be seeing that the price is using either the yellow or the black as the 50 and the 100 as support. Is bouncing on it. Confirmation number 2. It has gotten to my Fibonacci retracement zone. Confirmation 1. Bouncing on the moving average and using it as support. Confirmation 2. And then giving me a candlestick pattern. Confirmation 3. And then boom, I take my entry in that area for a buy, long position. Then my stop loss will be behind the moving average. And then as much as I want it. So I use the moving average majorly for two things. To know if the momentum is still very strong in that direction. If it is a bullish market structure, I want to know that the momentum is still strong. That means the price is trading above the moving averages. Then number 2, I'm using the moving average as my support in a bullish market condition. Then in a bearish market condition, the price must be below all the moving averages for me to know that the momentum to the downside is strong. So, and then I use the moving average as my resistance. Very, very simple. And sometimes too, you will see that there will be more than 3 confirmation. You see that the trend line too, the price is coming around the trend line, around somewhere here before taking off higher again. But not all the time. Just look for 3 confirmations, not just one. That's why I said never use any of these tools in isolation. 2, 3, 4, not necessarily 4. Once you can get 3, you are good to go. Once you are saying, why am I trading? Why am I making this entry? What are my confirmations? It is just because of the price is on the trend line. What about the moving average? What about candlestick confirmation? So once 2, 3, 4 analysis is forming a confluence, especially 3 or more, that is when you are good to go. And you can always spot this on a daily basis from different instruments. We have thousands of assets to trade. In commodities, we have hundreds of commodities to trade. Oil, gold, silver, rice, wheat, Many of them in indices, a lot of them, US 30, NASDAQ, S&P 500, DAX 100, and so on. And then in stocks, you have Apple, Google, Tesla, and so on. So when if we go off now, we will come in again so that we can take question, strengthen the explanation, because we might go off in the next 1 or 2 minutes. This session we end, then we can come back. I'll send a link to the group. You can come back, and then we strengthen the explanation, and then we ask questions to end today's training. So from Monday, we'll start sending trading setup, not just the signal. We will also share the screen of how we are making the setup. For example, let's say we are making a setup on oil. We will send the signal, buy oil at so price, stop loss at so price, take profit one, take profit two at so price. Then we'll also share the setup so that you can see, okay, this is the reason why these people are saying buy this asset. You will see for yourself, you will see the confirmation. Then try to practice. You see, we can just create this community and just be giving signals. But definitely one day you will need to trade all by yourself. So if you don't learn this thing now and you are just enjoying the signal, making money with the signal, when you are left alone to trade all by yourself, if you don't learn it now, that might be your trading journey, the end of the trading journey. That is why you should learn it. And that's why this community is taking this effort to make sure that we are a blessing to as many as we are able to get to. My mentor, Jason Sen, who has been trading for 40 years now, I know how much I paid to have one-on-one class with him. I have paid for so many signal groups, so many teaching group. This one $1,000, this one $500. All is zero until I met Jason Sen. I spent time with him, and then my trading journey changed, transformed.